Hello and welcome to the DGI Crab. In this video, we're going to be discussing what I refer to as the Tier 1 stocks or the Tier 1 group. These stocks are primarily designed for the 18 to 30-year-old investors, 30 and younger. And we've got a list of stocks here that meet some particular characteristics. So here's why I think that these stocks are ideal for people that are 30 and younger that are looking to build a dividend growth stock portfolio. So when you're looking at these stocks, first of all, with individual stocks, we're generally only going to be buying them if their starting yield when you're purchasing them is at least 20% higher than their 4-year average yield. We're not going to go into where they are today. This is just a general overview of these stocks, but we're typically looking for a starting yield around 1.5% to 2%. Now, not every stock on this list is even going to yield that high, but that's about what we're shooting for here. More importantly, we're looking for an annual dividend growth rate to average 10% or better. So with this group of companies, if you're buying them, especially when they're on sale, you're hopefully getting that 1.5% to 2% starting yield as a group with a growth rate of 10 to 13%. Now, time in the market is where these are really going to be your friend. That growth rate year over year at 10% or better is going to rapidly grow your passive income the more time you have in the market. So that's why these aggressive compounders of annual income are so important the younger that you are, because you have so much more time to let these sit and increase and grow and reinvest. If you're 30 and younger, especially, I do not recommend that you chase high dividend starting yield with low growth rate. Now, that doesn't necessarily mean that if you're older than 30 that the stocks on this list are poor investments for you. But if you are 30 and younger, these types of stocks really should be your focus. Again, I'm not a professional advisor, so do your own due diligence when investing in any stock or ETF. But I have gone over literally hundreds of stocks when putting together these tiered lists, and I'm of the opinion that this is the cream of the crop if this is the goal that we are looking for. So let's take a look at the stocks that we have here. These are not ranked in order of how much I like them or how good of a value they are on this particular given day. They are just listed alphabetically. So I'm not going to do a deep analysis on each of these stocks. We're just going to look at the characteristics of them and why they made my list here for the Tier 1 investor. First up, we have Analog Devices, stock ticker ADI. They have a market cap of $114 billion. They have been increasing their dividend year over year for 20 consecutive years. My expectation for their annual dividend increase is usually going to fall between about 9 and 12%. And this is a Morningstar wide moat company, which just means that if a stock or a company has a wide moat, it just means the barrier to entry for their competitors is going to be particularly difficult. So a lot of these stocks, as you're going to see, are Morningstar wide moat stocks. On to the next one. We have Automatic Data Processing Incorporated, stock ticker ADP. They have a market cap just shy of $100 billion at $99 billion. They have been growing their dividend for 49 consecutive years, and next year, when they increase their annual dividend payout, they will have hit year 50, which makes them part of a small but illustrious group of stocks known as Dividend Kings that have increased their annual dividend for 50 or more years. I would expect an average annual increase of this company to pretty consistently fall between about 10 to 13% most years, and they are a Morningstar wide moat company. Next is Aflac Corporation, stock ticker AFL. The duck. I'm the crab. This is the duck. I think we all know the duck. They have a market cap of $49 billion, major player in the insurance industry. They have been growing that dividend for 41 consecutive years. Average annual increase is probably going to fall between 9 to 12% in most years, and they are another Morningstar wide moat company. Next is Broadcom, stock ticker AVGO. This is a massive company with a market cap of $804 billion. They have been growing that dividend for 13 consecutive years. And don't let that lower number compared to some of the other ones to fool you. They just haven't been paying out a dividend as long as some of the others on this list. But I have no reason to believe that they're going to slow down growing their dividend anytime soon. They've been growing it at a massive pace as of the time of this recording, and I'm expecting an average annual increase of anywhere from 13 to 17%. And this is, again, a Morningstar wide moat company. Next is CTAS Corporation, stock ticker CTAS. They provide uniforms for companies all across the country. They are the largest player in this space. They have a market cap of $70 billion. They have been growing their dividend for 41 consecutive years. And the average annual increase on this major compounder is usually going to fall between 13 and 18%. And once again, this is a Morningstar wide moat company. Next up is the Kroger Company, stock ticker KR. Kroger is a massive grocery store chain, and they also have plenty of Kroger brand products that are sold in grocery stores from coast to coast. Kroger has a market cap of $36 billion. They have been increasing their dividend for 16 consecutive years, and they've been doing so at a pretty rapid pace. I'm expecting an annual increase of about 12 to 16%. Generally speaking, the brick and mortar stores of just about any kind don't get Morningstar wide moat ratings. So this is not something that I necessarily have to have when purchasing a stock. They don't have to be a wide moat company. The main thing that I'm looking for is, are they on sale and are they expected to continue increasing that dividend? And Kroger certainly fits the bill there for me. Next is Lowe's Company, stock ticker LOW. Lowe's has a market cap of $127 billion. They have been growing their dividend for 60 consecutive years, one of the longest annual dividend streaks of any of the stocks out there. They've been a dividend king for a decade now, and their annual increase is usually between about 13 to 16% most years, and they have plenty of room to continue growing their dividend at a rapid pace. And Lowe's is, in fact, a Morningstar wide moat company. Next is Microsoft Corporation, stock ticker MSFT. Microsoft is the largest company at the time of this recording in the United States by market cap. We're not talking about billions of dollars. We are talking about $3.2 trillion market cap. Now, some people will say that Microsoft is not a dividend growth stock. I beg to differ. Now, with Microsoft, it's pretty rare to get a starting yield nowadays of Microsoft to hit that 1% range, but they've been increasing their dividend since they started paying one. So they've got 19 years. I fully expect them to continue growing that. I can't imagine they won't be a dividend king 31 years from now. They are pretty consistent with their dividend growth rate. It's usually around 10% or a little better. So I'm expecting 10 to 12% out of Microsoft year to year most years. And they are probably as wide of moat of a company as you are going to find today. Next up is Nordson Corporation, stock ticker NDSN. They have a market cap of $13 billion, so not as big as some of these other companies on the list so far, but if you look at that history, 59 years of annual dividend increases, and this is another major compounding play with an annual increase expectation year to year of about 13 to 15%. So if we can get Nordson on sale comfortably above a 1% starting yield, that is going to increase rapidly year over year. They've been doing this for decades. Next up is Nike Incorporated, stock ticker NKE. Nike's the largest shoe manufacturer on the planet. They've got a market cap of $140 billion. Nike's grown their dividend for 21 consecutive years, and 4 years from now, I fully expect Nike will join the list of dividend aristocrats, which are companies that have grown their dividend for 25 consecutive years and are also in the S&P 500, which Nike absolutely is with that $140 billion market cap. Year to year, an annual increase expectation, usually about 9 to 12%, and Nike is also a Morningstar wide moat company. Next is Parker Hannifin, stock ticker PH. Parker Hannifin has a market cap of $64 billion with an astounding history of 68 years of growing that dividend. They are in the top 5 of the longest dividend streaks of all of the publicly traded stocks in the United States. And the annual increase expectation for Parker Hannifin is anywhere from 12 to 16% most years. Next is Sherwin-Williams Company, stock ticker SHW. Major paint manufacturer. They have a market cap of $75 billion, a 45-year streak of increasing the annual dividend. The annual increase expectation, another major compound play here, you guys, 12 to 15% in most years, and they are, you guessed it, a Morningstar wide moat. Next up, we have S&P Global Incorporated, stock ticker SPGI. This company has a market cap of $135 billion. They just became a dividend king within the last year. They hit that 50-year consecutive dividend increase streak. Usually this company is going to grow that dividend about 10 to 13% year over year, and they are a Morningstar wide moat company. Next up, United Health Group Incorporated, stock ticker UNH, one of the largest companies in the United States, regardless of industry, with a market cap of $457 billion. They have been growing their dividend for 14 consecutive years at a pretty rapid clip of 13 to 15% year to year. Next up is Visa, stock ticker V, the largest payment processor on the planet. Visa has a market cap of $541 billion. They have been growing their dividend now for 15 consecutive years with an annual increase expectation of 15 to 20%. Now, Visa is going to have most likely the lowest average starting yield of any of the 60 stocks that this channel focuses on. It's probably going to be a pretty rare occurrence for Visa to be yielding as much as 1% when you buy it. But with a 15 to 20% expected annual increase year over year, Visa's that means that the dividend that you acquire today is likely going to double about every 4 to 4.5 years. So if you're 18, 21, 25, heck, even 28, and you've got multiple decades to just sit and let this grow and compound, just $100 or $200 invested in Visa could be yielding you more than $1,000 a year by the time you've hit retirement age. So definitely an exciting one as far as that goes, and they are definitely a Morningstar wide moat. Next up is Waste Management, stock ticker WM, one of my absolute favorite companies to invest in. Somebody has to pick up the trash no matter what's going on in the country or the economy, and nobody does it more or has a larger market share in this space than Waste Management. They have an $81 billion market cap. They've grown the dividend for 20 consecutive years. They could be a little bit conservative in some years with how much they increase their dividend, but usually you're going to get about an 8 to 11% increase, and they are a Morningstar wide moat company. So that is the list, you all, of the Tier 1 dividend growth stocks. Again, there are certainly some other companies out there that might meet some of the criteria out there, but in terms of the history, the market share and market cap, and the expected annual increases that have happened year over year, these are companies that have just proven track records that you can sleep very well at night when you are investing in them, especially when they are on sale. So that is the Tier 1 stocks from the DGI Crab for the 30 and younger crowd to focus in on. Send me any questions that you have at dgicrab@yahoo.com. Check out the links in the descriptions below to some other videos, and I will see you on the next one.